Welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, Exercises Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And in the last video, I thought I'd be able to do 35 and 36, but now after 9 minutes, I decided to break them up. So now I'm going to be looking at 36 and most likely 37. So let me get my pen here. And it says here, balance sheet disclosure of liabilities. All right, so kind of the same thing that I was talking about for exercise 9-36B, in that it was the way the information is presented on the balance sheet. So it says here, at December 31st, Padilla Industrial owes $370 on accounts payable, excuse me, plus salaries payable of $85, income tax payable $11,700. Padilla also has $180,000 of notes payable that require payment of $22,000 of a $22,000 installment in 2015, and the remainder in 10 years. Remainder in later years. Sorry. The notes payable also requires an interest payment of $9,000 on January 1st. Report Padilla's liabilities on its December 31st, 2014 classified balance sheet. Okay, so again, this here is and as far as formatting issues are concerned, I'm not going to be picky on this. As far as my writing here on the video, look at the solution in the owner's manual for the way it. Actually, I'm going to somewhat disagree, but for a little bit with the way the information is presented, because I'm using multi-step versus single step. Although the solution does, it is acceptable to use this the single step format. And I mean, I'm not going to say it's wrong. I mean, it is right. It'll look a lot neater, basically, than what I'm going to write here on the slide. But I like doing things in the multi-step. I thought I'd save space there. So anyway, liabilities. Okay, so then we're going to have our current, and I'm abbreviating here, current liabilities. So we're going to have an accounts payable, and the accounts payable is $37,000, plus the salaries payable. I'm abbreviating. Don't you abbreviate. $8,500, and income tax payable of $11,700. Okay, so that's 85, 11,000. Also has a note payable that required a payment of 22,000 installment and the remainder in later years, and the note also requires an interest payment of 9,000 on. Okay, so it requires an interest payment of 9,000 on January 1st. Okay, so we're looking at, and that's 2015. So we're looking at the end of December. Okay, and since it's not paid, let's draw a timeline here. Since we're looking at 12/31/2014 when we're making this here balance sheet, okay, it says requires an interest payment of $9,000 on January 1st. okay? Well, January 1st, 2015 is the next day, right? So this $9,000 up until December 31st, we've accrued that interest, okay? We're not paying it until the very next day, okay? Not paying it until the next day. So that $9,000 is, even though it's an interest payment, it's not interest expense. We're looking at the liability. If we were to make the journal entry for that adjustment, we would debit interest expense for the $9,000, and we would credit interest payable for the $9,000. That's the adjusting entry we're going to make for this $9,000. So that shows up on our balance sheet as an interest payable for $9,000. Okay? And that's the thinking behind that $9,000 there. Pause the video, watch it again, rewind it if you didn't get it. But you should get it, all right? I mean, it's an interest payment for January 1st, right? But we're doing the balance sheet as of the 31st, so that $9,000, we've accrued the $9,000, and you get that journal entry, and it shows up on the balance sheet once you make all of the adjusting and closing entries. Okay, and let's see here. We have the last thing we have to consider is from our liabilities, our current liabilities, is we have a $180,000 note payable that requires a payment of $22,000 installment in 2015. Right. So they're telling us that that is for the 2015. If the payment is, if that payment is $22,000. Remember, current means between now and the next 12 months. So for the entire year of 2015, that's $22,000. Well, that's the same what we would have in 2014. So we're going to have our note payable current portion of $22,000. Okay, and this is going to give us a total current liability of $88,200. And notice that I'm using multi-step here. I mean, like I said, the solution is not wrong to have a single step. And using the single step kind of like works if you're only looking at a portion of a balance sheet. But if you're looking at a full financial statement, you're better off using the multi-step format. Okay, so then we have our long-term liability, and of course I'm abbreviating here, and that is our notes payable. Now notice, and this is a deviation, notice that the solution goes and says our notes payable is $158,000. Okay, how did they get that? Well, it's $180,000 less the $22,000 that they paid for 2014, which gives us the $158,000. Right? I'm sorry, which the $22,000 is the current portion, right? That's the current portion. Gives us the long-term portion of $158,000. Now, I'm going to show you how I would do it, which obviously makes more sense. So I have the I have the note payable for $180,000. Okay, and then I would have the description of less current portion of the note payable, which would be $22,000. Oops, I don't put in the brackets. You just leave the $22,000, right? And that would give me a long-term portion of the notes payable for, oops, 150, oops, wrong spot. Boy, get my act together. I'm looking at trying to fit stuff in at the bottom of the screen here. So I have 158,000, and that would give me my total liabilities of 246,200, right? But wrong spot. $246,200. Okay. And of course, I don't have an underline here. So remember, with the multi-step, whenever doing mathematical calculations, we move one column to the left. So that's why we've done the math here, and we put that number here. We've done the numbers here, we put that there, and we're doing the math here, and we're putting that number here. And remember, this here is my total liability, so that I don't underline here because I'm going to add my liabilities plus my equity in order to get my total liabilities and equity. So I'm going to have my total liability added to my total equity. I don't use an underline there. But again, in all of that math, whenever you're doing the math, move one column to the left, put the number to the right, and that's kind of like how the formatting of my financial statement would look like. And again, there's nothing wrong with what's in the book as the solution, but that's single step, and it works fine when you're able to just look at a portion of a financial statement. But when you're looking at complete financial statements, you're better off using the multi-step, and that's what I'm showing you for you to be able to learn. Okay. All right. So let's jump down here to 9-37. Yeah, we'll get done with this in this video. All right. So we have the debt ratio and the interest coverage ratio. The following balances are here, and it says calculate industrial supplies debt ratio as of December 31st, and then calculate the interest coverage for 2014. Around your answers to two places. Right. I'm going to work it out. I'm going to work out the debt ratio, and then I'll work out the interest coverage ratio, but pause the video and write it down because I'm going to end up erasing here. Okay, so we know our debt ratio. Our debt ratio is our total liabilities over our total assets. Okay, so when we look up here, what do we have for our total liabilities? Okay, so we have a total current liability of 20,000, and we have a total long-term liability of 200,000. So 20,000 plus 20,000 plus 200,000 is 220,000 for our liabilities. So 220,000. And for our total assets, we have current of 80 and long-term of 320. So 80 and 320,000 is 400,000. So 220,000 divided by 400,000, and when we do the math, we get 0.55 or 55%. Okay, so that's it for our debt ratio. Relatively simple. Total liabilities over the total assets. Right, and it's just I kind of dislike the way they present this information here because they don't. They're telling you what it is as if it's categorized. And yeah, you'll have a current asset. You'll have your property, plant, and equipment versus long-term assets. You'll see a section for current liabilities and your total long-term liabilities, and you're able to pick those numbers up, right, off of the financial statements. But you have to kind of get used to looking for those numbers because that's exactly what it is. You'll be looking for them. Sometimes you may, especially with small businesses, you might, you will have, your total assets. So why bother with this? and you have your total liabilities, so why bother with that? Okay, it's just the way the financial statement is presented. All right, so interest coverage. Interest coverage is earnings before interest and taxes, and that's divided by our interest expense. Okay. So our earnings before interest and taxes is $73,800, and our interest expense is $18,700. Okay, one divided by the other, and you get 3.95 times. And that was just as simple as that. Okay, what to say about this? The earnings before interest and taxes. Excuse me. You're talking about your profit or loss. You know, and this is where terminology comes into play, semantics. You know, when we're talking about revenues less our expenses, I kind of try to use profit or loss, but you might also see that as net income or net loss. Okay. Net income or net loss, the net income is actually after interest taxes, okay? Because that's a net. So you end up with a profit or loss less earnings and taxes to give you your net income here, okay? So you have interest and taxes here to give you your net income. So, you know, kind of like be careful of what you're looking at as far as terminology is concerned. This earnings before interest and taxes, think it through as revenues less your expenses, and whatever number that is, whatever it's being called, and it could be called profit or loss or net income, right? It doesn't matter what it's being called, that's the number that you're looking for, okay? For your earnings before interest and taxes. Don't just think, oh, I pick up my net income. Well, you could have this here number, less your interest, less your taxes, and this is net income down here, and you're picking up this X and sticking it in there, okay? That's wrong, right? And it's just a matter of the terminology that's being used on the financial statement. You have to think through the underlying concept of what you're looking at, regardless of the naming conventions, okay? So I just wanted to point that out. Those who are going to go into intermediate accounting, you know, that little spiel was basically for you, okay? For mostly everybody else, like business management people, you know, you're generally not going to be doing that type of analysis, but you know, it's part of the curriculum, so you know, take it for what it's worth. Okay, so that's it for all of the exercises from the Group B. And again, if you don't understand, you know, something, go back and watch the theory, and you know, ask an instructor. But we'll be moving on to the problems in the next series of videos.